In our strategy, we work with a 5-phase cycle framework. We are not predicting headlines or dates. We track how pressure builds and how risk transfers through the system. This conversation is not about a market crash tomorrow. It is about something quieter and more important. What happens when the dollar stops doing as much work for us? We are reviewing a discussion from the Jimmy Dore Show. The guest is laying out a structural argument about U.S. debt and reserve currency dynamics. You should absolutely watch the original for full context. The core claim is simple. The U.S. can run massive deficits because the world uses dollars, and that privilege is slowly being worn down. Countries hold dollars to trade with each other. They also hold U.S. debt to store those dollars safely. That spreads inflation away from U.S. consumers. This is happening because other countries absorb our money creation, and when they stop doing that, inflation shows up at home much faster. When that happens, prices and rates usually rise together. Sanctions push countries to find alternatives to the dollar. Trade slowly moves elsewhere, and each step reduces external demand for U.S. debt. Reserve currency erosion is slow. Markets can function normally for years while this is happening, until marginal buyers quietly step away. Gold is not magically going up on its own. The dollar is losing purchasing power relative to it. That is a confidence signal, not a timing signal. In our strategy, this fits phase 2. Policy delay hides deterioration. Fragility builds underneath stable headlines. It lowers confidence in future policy control. It raises the value of flexibility, and it pressures assets that rely on cheap funding. This does not mean immediate collapse. It does not mean abandoning risk entirely, and it does not override confirmation rules. Interest rates are not fully controllable anymore. If buyers demand compensation, yields rise, even when central banks would prefer otherwise. Highly indebted governments feel it first, then rate-sensitive sectors, then consumers. Our response is not panic. We preserve optionality. We avoid being forced into decisions. Quick note here, this is educational macro commentary only. It is not financial advice. We watch treasury auctions. We watch term premium behavior. We watch dollar funding stress. If this way of thinking is useful to you, subscribing helps you stay grounded in process instead of headlines. It gives you a consistent framework to interpret noise as conditions change. This view weakens if foreign treasury demand stabilizes, if deficits narrow structurally, or if monetization pressure fades. We do not need to be early, we just cannot afford to be late.